For those that never came to a group therapy session before, welcome. This is a little bit more informal than a regular webinar. So unlike webinars, these are focused on a narrow area. They're not scripted. It's informal, it's interactive, and we might end up going somewhere that I hadn't intended. But saying that, I still pick the topics each time. I sometimes do some months say, okay, what do you want to talk about? Because basically somebody needs to, right? And that's usually a combination of things that people have been asking me in the month, or maybe things that are going on in the markets. And today we're talking about situational awareness. Now, one of the things to bear in mind is, the point of group therapy is to build skills and iron out problems. Now, obviously, if you're going to iron out problems, there's some problems that people don't have. In fact, there's some problems you might not have come across yet. And there's also the point that you don't need to build out all the skills as a trader on day one, right? So we're always trying to layer on new skills as traders. We're always trying to improve. It is a game of continual improvement. But, you know, if what you hear today you feel is a little bit too advanced, that's fine. You don't need to bite this off immediately, right? It's something, you know, we can come back to the video. You can come back to this later. Don't try and jam everything on all at once, because you literally can't learn too many skills at once. So if you're still trying to figure out which color the buy button is, then don't overload yourself with what we're going to talk about today. But if you're not making money, or you're going from sim to live and sim to live and sim to live and back again over and over, then have a think about this as your next focal points. Because for many, what we're talking about today is going to give a big increase in confidence through better decision making, but also to have a better idea of when you should and shouldn't trade, and when you should trade a bit harder and maybe throw a bit more size. Because you don't trade in isolation of the outside world, right? So when you're sitting there at your screen, it feels like you and the DOM, you and the chart, whatever it is you're using, and it feels like it's you and that chart, and those are the two people that are playing this game. And it's not. It's a big world out there with the sum of activity from a whole bunch of participants with a whole bunch of different inputs that's been shown on your trading platform. So today we're going to discuss building more awareness of exactly what is driving others to trade or not. So that's situational awareness. And we're going to talk about different situations, different scenarios that affect the market, but there is no single type of scenario or situation we need to be aware of. There's many types of inputs that drive trading, and we'll try and discover and cover the most significant ones today. Now, we've all seen this. Have you seen this one before? John, can you hear? Can everybody hear? If nobody can hear, I have to start again. Yeah, okay, right. So, we remember this slide, right? We've shown this on group therapy many, many times. And the idea is that as traders, we know that as time progresses, volatility goes up and down, right? We talked about it. We've been talking about it for at least a year and a half. We've lived it. We've breathed it. We've seen markets cycling up and down in volatility. Well, let's just add a little bit to that, because trading is specifically more difficult or more challenging right now. I don't mean like a year ago. I don't mean 6 months ago. I mean like right now, today. So we've got basically a market that's a bit strange. So if you'd come to the S&P futures in 2015, you'd see a market where on a typical day, you'd get into the market, there'd be a drive up off the open, you know, it could be a 3 or 4 point drive up. Then you might drive down 10 points. Then you might drive up 15 points, come back down 12 points, go up 10 points. And you generally have somewhere between 2 and 4 really solid intraday moves on the S&P that would happen most days. That would be the norm. And that would be the norm on days that were low on news. So does anybody remember that like 10 to 15 point swings up and down? Okay, so the guys that remember that, is that what you're seeing every day today, right? right? Because it's gone. It's gone. Now, it doesn't mean that it won't come back, right? It doesn't mean that at all. But for now, we don't have that. So nowadays, on days when we don't have good news, we don't see those big things. It's like real chop fest, right? So one of the things is we're in an environment where there's a lot of news at the moment. We got, what have we got? We've got, all this stuff, Brexit, China trade, Fed. If it was just Brexit, we'd be volatile. But the China trade war, there's always announcements from the Fed. There's Mr. Trump as well with his tweets and stuff like that. So we've got this environment where there's a lot of news coming out, and that's creating a lot of activity in the market. And the downside of that seems to be that when there's not a lot of news, then there's not really a lot going on. So it used to be there's not a lot of news, so we'll go up 10, down 15, up 12, down 10 every day. Fine, no news, right? It's changed, and I think it's changed just because you've got that environment where you've got the big news, and people are able to make some. We're getting that opportunity when the big news in, and when it's not there, I just think it's caused a lack of interest. It's like being a junkie and you've got a fix and you're really happy, and when you haven't got a fix, you kind of I don't want to. I'm not really interested anymore. Okay, would I rather have no tweets and no activity? Ari's asking. Actually, I'd much prefer it if it was way back to 2 or 3 years ago where we had those swings, because it was quite predictable. But I think it will come back. I don't think it's changed forever. I think it'll come back. But we've been talking about this stuff for so long about the way the markets change. It's just one of those changes, right? So you can't keep doing what you did before. Now, so we get markets reacting, but they're not really quite, it's not a knee-jerk reaction, right? So we have to think about the actual reactions that the market's making to the news. And we might think that the reactions are random. And to a lot of people, they probably are random because they haven't studied them. But do we all know what efficient market hypothesis is, EMT? Efficient market theories or efficient market theory or efficient market hypothesis. Okay, so the EMT or EMH or whatever it is, efficient market theory, says that everything that the market has already priced everything in. That everything there is to know has been known, and at any one point in time, everything that is known is priced into the market. In other words, it's kind of a way of saying you can't make any money from information because all the information is already priced in. But it's also a cop-out saying, well, if the market's at like $10 and it goes to 20, it's like, well, at $10 it was pricing in what it knew. So, and it's an interesting thing because if you think the market's already priced news in, then when news comes out, you get a big news event. In theory, the market would move from where it is now to a destination price immediately, right? So, Lars, it's basically a way of saying you can't win or you can't beat the market, right? That's basically what it is, because the market's already taken into account of everything. So there's nothing an individual can know that could help me predict, right? Now, the opposite, or the way I kind of look at that, I think, okay, if that's true, why is it when we get a big news event out, why does it take 3 hours from the market to go to one place to another place in reaction to that news? And the reason it does is obvious, is because it takes time to do that business, right? If somebody's got to unload a big position, they don't just go bang and put that big position out into the market all in one go. They'll put it to a firm who then works that order. Probably, it's one of the things that algorithms do is they'll end up working that order over time to try and make sure they don't move the market too much and affect the average price that they get. So if a market starts at 10 and there's news and it goes to 20, it could take 3 hours on the way from 10 to 20. And in that time, there's no way that was an efficient market, because the move from 10 to 20 would have occurred the moment the news came out, right? So if the market's already priced everything in, it would not take 4 hours to move, right? And exactly, Mike's saying, one other way to think about EMT is that the market's always trading at value. Yeah, but like, if the market's on the way from 10 to 20 and it stays at 20, it was like, what does it mean? What was the value on the way? These people knew at the start of the day that they were going to dump or buy that many shares or whatever, And so the value to me is where we ended up, right? And you wouldn't have any swings, right? So the market's not pricing everything in. It does take time for the market to move. It takes time for institutions to work into and out of big position. It takes time for people to jump in and jump out. And also people have different trigger points. There are different things that make people react. So whatever you do as a trader, one of the things you need some activity. And the other thing to do about trader, this might seem like a kind of a diversion, but whatever you do as a trader, we're really looking for patterns in that activity, right? Now, the problem with patterns is that most of us think about patterns as when we first came to trading, we think about patterns as chart setups. We think visual, left to right, candlesticks, squiggly lines, that kind of thing. That's what we think. I mean, it makes us think about technical setups. But when you think about patterns, it doesn't have to be like a head and shoulders or a crossover. It doesn't have to be a pattern with a narrow and finite set of inputs based on price. The reality is there's a lot of stuff impacting the markets, like Trump tweets, and there can be a pattern around those tweets, right? So it doesn't mean patterns can be boiled down into something simple. And I'm going to give you a couple of examples of traders that I know that traded patterns. Now, one of the trades I like to talk about a lot was, good grief, I'm trying to think of what year it was now, early 2000s. There's one trader I know, didn't know him very well, but I knew somebody who worked for him really, really well. And he was a young guy, and he'd made $18 million on his own account. Done that basically by borrowing a lot of money. He had some really good information, and he borrowed a lot of money from friends and stuff, and he made 18 million. But he was also a really good trader anyway. It wasn't his first trade. And he ended up trading a $30 million account, but it wasn't his money. It was hedge fund money. And what there was at the time, I don't know if it's still the case, I really don't have my hand in that world. At the time, there were these boutique hedge funds, and they would give people like him money to trade, right? And so the way they traded, it's a very common way to trade. There are lots of people do it right now. If you go to a website called briefing.com, you will see that website is focused around giving you news releases around companies, so that you know which companies are in play for the day, or which companies are probably in play for the day. So if you're a stock trader, an intraday stock trader, there are thousands and thousands of stocks. So one of your jobs as a stock trader is to figure out which ones are actually going to be moving. Now, 4 times a year we get earnings season, and what earnings season is each listed company in the US will have to give out their quarterly earnings. They'll do their accounts and they'll actually announce their quarterly earnings, right? And on briefing.com, it'll tell you which companies are announcing. I think it's just, I'm not sure if there's a midday one, but there's a pre-market announcement, and then there's a post-market announcement. So there's some companies that will announce in the morning, and there are some companies that will announce in the evening, right? And so briefing.com is all about giving you those earnings announcements, right? So these guys would use briefing.com, amongst other things, and 4 researchers and one trader, and they would track every quarterly earnings announcement. Now, what happens with these earnings announcements, that's when they're giving actuals. But through the quarter, companies will say, they'll have an estimate. And they'll say, okay, we've got an estimate that our quarterly earnings will be X, so many cents per share, right? And so and what they'll often do is they'll revise that estimate through the quarter. Now, some companies will consistently underestimate their earnings, right? Consistently. And I guess the way they see it is it's like a bit like going to a candy shop. And sometimes you go to the candy shop and they'll measure your candy out. This is show my age. I'd measure your candy out. And some guy in the shop would put a bit too much in and then take some candy out. But another guy would put a little bit of candy in and then add some. So you end up with the same weight, but it looks like the second guy's giving you a bit extra. I just think these guys felt that if you underestimate your earnings, right? If you underestimate your earnings and then you beat your estimation, it makes you look good. But it also it's also something that people look for. So not only did they know which companies consistently underestimated or overestimated earnings. I don't know actually if anybody consistently overestimates or come in on target, right? So they'll know that. Does this company usually underestimate? Then they will also know how does the market typically react to a hit or a miss on their earnings, right? So they'll research that. So they'll know for every stock or every, stock of a decent size, like thousands of them, they've got these spreadsheets and stuff, and they've got for everyone. They know every quarter consistently, what did they do? An estimate, what was their actuals? What was the news coming out leading up? So that for each stock that was going to announce tomorrow, they do some over the weekend as well, for the week, they'd be looking in the news, what's been in the news? Is there any news that says they're going to be? And they'd come up with a game plan. These guys usually underestimate. It looks like from the news that we've seen so far, they're going to come in ahead. And when they do come in ahead, typically, this is how the market reacts. Okay, so they come up with this expectation. Now, sometimes the announcement comes out and it's they're above estimate and it's flat, and then that's fine. But they have a good idea. So they have a good idea. Not only how do they normally report, above or below, how does the market react to that? And that's what they traded, right? That is a pattern as much as a head and shoulders is a pattern, right? So we understand, you get that's a pattern, right? Yes or no would be nice. Okay, so it was good. So it was just information. The guy who was trading it still had to make an assessment when he was trading it. He started to think, it might be that it went up in the pre-market and they weren't trading the pre-market. And he'd be like, well, it's already gone up a bit and I'm going to wait for it to come back. I want to wait for it to come back a bit before getting in. Something like that may happen. Now, Axia. There's a lot of controversy about Axia, especially when I put posts on Elite Trader about Axia. They have some really big days, and there's a lot of people that say they are taking far too much risk because they're hitting these big economic releases, right? It's okay. That's a very good question. NSXR, great name, good question. So this is fundamentals, okay? It's not really fundamentals. Fundamental analysis would be looking at the balance sheet, looking at and trying to find a stock that's undervalued, right? This is pure trading. I don't. You couldn't really call it fundamentals. You couldn't call it technicals, but it's a pattern, right? So they've seen a pattern where a company consistently does this and the market reacts in this way. So they look for the first thing, which is the layup, right? So So we've got Apple. They've come in above estimate, right? Apple have come in above estimate. What do? We want to buy Apple. Now the trader still has to buy Apple. He's still got to find a good entry price, right? Or decide to just jump on board, right? So he's still going to for him, he was still reading his level 1, still watching the order flow, all that kind of thing. But he was basing it based on this information. And like Mike's saying, there are quant funds that use this method. It's quite a crowded space. It's a very crowded space because even if a site like briefing.com that you can get for $99 a month, selling that to thousands and thousands of retail traders who are trying to do it as well. But your typical retail trader at home doesn't have 4 researchers, right? Anyway, Axia, they trade news announcements, right? So again, the thing about Axia, right, is Axia don't just sit there when there's a news announcement and just whack into the market, right? So, some people say don't trade the news. People say don't trade the news. And it's great advice if you don't know how to trade the news, right? I can say don't trade earnings announcements if you don't have 4 researchers and a trader. But so when you look at don't trade the news because it's going to get really volatile. Yeah, it's going to get really volatile. But do you watch every announcement? Do you know, for instance, when the PMI comes out, that maybe sometimes when we get a beat PMI, that the market spikes up and then there's a big push against the market, right? So again, with these economic releases, there are also patterns, and there are patterns that come and go as well. So typical reactions to hit and misses aren't so black and white as when it hits, it goes up, right? When it misses, it goes down. It's a bit more nuanced than that. It's like, well, on this particular announcement, when we hit, typically there's somebody who comes in and whacks the market up, and then they just pull all their orders and everybody gets caught and the market goes the other way. So again, it's that kind of pattern. It's not like, don't try and guess what the pattern's going to be before you watch it. So you can start looking, if you wanted to watch every economic release to this extent, and watch every economic release, and then watch markets. You can't even guarantee at this point which market's going to react. So don't begin to presume that. But you might be watching that economic release and seeing there's a very specific reaction, or it's being traded in a very specific way. Like, for instance, people might sell against it initially and then drive it up, right? So that's a pattern, right? Now, order flow trader. If you're a pure order flow trader, right, and you're typically looking at ledges, traps, fakes, breakouts with good risk-reward opportunities, that's also a pattern, right? And now the similarity, and the reason I wanted to talk about the first two, right, is because the pattern that you're looking for is an event with a reaction, right? So with this kind of pattern, the earnings event is the event that has a reaction. That reaction is typically, it depends, right? The action could be it all gets repriced in pre-market. There's not much there in the day session. The reaction could be it moves for 4 hours, right? So with that kind of event, you've got like a scope of reaction. Like, so in instance, if Apple beat earnings, it's not going to move up for 6 months. It's going to be done in a day or two, right? Like sometimes when the earnings come out in the evening, you get a bit of a blip, but it's the next day you get reaction. Sometimes you get earnings and it'll push up and they'll just sell it off, right? So there's a reaction and there's a scope to that reaction, right? So if you're looking at order flow with good risk reward opportunities, it's also an event that you're looking for that has a reaction. And it's one of the reasons that technical analysis doesn't really work, right? And I'm sorry if that's sacrilege, but if you think about two lines crossing each other, like a moving average crossover, that is not an event. That is not something that's going to make people react. If you look at the basic order flow setup with the absorption setup, that is something where maybe a market's moved down, somebody's absorbed the selling, and if it moves up, those sellers are going to get stopped out. That is a reaction, and you know why, because those sellers are getting stopped out. The crossing of two lines on a chart doesn't represent anybody doing anything. It doesn't represent anybody doing anything at that point, right? So you've got like the trigger, right? The trigger that you think might trigger a reaction, and they've got the reaction itself, which means, and I'm going to tie this all up. This all makes sense in a second. So you think I'm going to go going all over the place. It means there's a scope to any signal, right? So, you've seen news events. You've seen the FOMC. FOMC, what's the post FOMC move? How long does it last? 30 minutes to an hour, right? So that's the scope for an FOMC move, typically. So if you think about the picture on the left, that's you dropping a pebble into a pond. Anonymous, I'll come to the questions in a little bit, right? So you drop a pebble in a pond, it makes a little splash, right? Guy on the right is going to make a bit more splash than a pebble, right? So if you break out, let's give you an example. If you buy the breakout of the opening range one day and you're still holding that position 3 years later and the market's gone up 300%, you can't attribute that 3-year move back to the opening range breakout, right? It's got nothing to do with it. Would you agree with that? Okay, so any setup or pattern is going to have finite scope to move the market, right? So there will be the scope of a successful trade, and there's also a scope of how much you can allow it to go offside and it still be a reasonable call, right? So you've got a scope of the successful trade and the scope of your stop. And that is effectively half of having a trading edge, right? He's really understanding the scope and the reason for the move. So like if it's an absorption event in a pullback, the scope is generally going to be, first of all, to the old high. So if we've moved up and pulled, let's say we pull back 4 ticks and there's absorption, or pull back 4 points and there's absorption, the scope of that absorption holding is at least to the high that we just left and beyond it. It's because it's a pullback. You're expecting to beat the highs, right? That is the scope of it. So that's what you're going to get out of it, right? You're not going to get a 300% lift in the market, but you are going to get, I should go through the high and possibly, as big as the next leg up. I can hold it for longer, but it's the scope of that event, right? Now the scope on a trade might be 10 units of scope, or I'm on a 10 tick range. I've taken a fade of the range. My scope is 10 ticks, 10 points back to the other side of the road, and the wiggle of the stop, that might be 5 points, right? So a good trade in that case, a good trade, a winning trade, would deliver about 2 times what a bad trade gives you, right? So there's that scope. So your break-even point then would be 30%. So if you're right 30% of the time, you can make money, right? So if your scope is 10 points, your stop is 5 points, you can be right 1 time out of 3, break even, right? So your scope of how much you can get, your risk, your reward, and your stop is your risk. That tells you what your break-even point is, right? So if your break-even point is 30%, you only have edge if you can win more than 30%. Would you agree with that? Okay, so a system that has a less than 50% win rate, in fact, we should say is win rate's irrelevant, right? Win rate is absolutely irrelevant, right? Because if you've got a setup that is a 10-to-1 setup, you can be right 50% of the time and make really good money. Or you can be right 30% of the time and make good money. And a lot of people got into their heads that if you lose more than half the time, it's not an edge. It's not an edge. It's got nothing to do with that. So the edge is a combination of the risk and reward and the win rate. So the risk and reward gives you a break-even point. If you can beat the break-even point, if the break-even point is 25% and you can get 35%, you've got a winning system, right? So for any of you, it shouldn't actually take you more than a couple of weeks to figure out if your setups have that edge. So you figure out the scope based on what your setup's about. Is it mean reversion? Is it a stop run? Is it new people coming to the market to take advantage of something? You figure out the wiggle, you figure out the break-even point and what your win rate needs to be. So, like I say, a good example for order flow traders is absorption plays. Great trades because one side is absorbing the flow of orders. Very beneficial from a risk-reward ratio. You could be wrong 70% of the time, but there's only edge there if you can get your win rate above 30%. Okay, so the edge is in being selective about which ones you take, right? So this is one level of expertise, one level of getting to profit. But long term, what you really have to understand long term is that scope or that break-even point is going to shift when the market shifts states, which is what's happening now, right? So you've got your setup. You've got your 50% win rate. It's a 7-to-3 reward to risk. You're winning 50% of the time. It's great. Market changes, those statistics have to change too, right? So if you think about a breakout trade on a really slow, low news day, the kind we're getting now between the news days, a really slow news day, the scope for that breakout trade is fairly low, right? It might just be a few points and then it kind of reverts back into the range. On a volatile day, where Trump's just tweeted something, a breakout trade is going to have much more reward on the table, right? Just as a slow day, your breakout's not going to give you as much as on a really fast day. Does that make sense? Would we kind of agree with that? You can disagree. Okay, right. So this thing about having your signal scape and your break-even point and your win rate is really important, and it's really important to getting to kind of like your first profits. And it's what really they push, like the new prop traders, because as a new trader, you can't handle that many different moving parts at a time, right? You can't. You might have learnt all these different things, but until you actually start using something day to day, it's really hard to stick it in your head. So the situational awareness is basically a layer on top of that stuff. It's like having your approximate method to get in and out of the market, and then being comfortable with that, and then saying, right, I need situational awareness to create a layer on top of that to stop you trading on low opportunity days and to try and make money on the days where there is more available. Okay, so what we're going to do is we're going to go through a few ways to look at situational awareness, right? And you can consider these drills if you like, and these are things that, as if you're still trying to figure out where the buy and sell buttons are, don't do this, right? You know, if you really are brand new, this isn't where you should start, I don't think. But if you are struggling and you feel like king one day and feel like an idiot the next day, this will really, really help, okay? So, first part of situational awareness, first thing you need to do every day, it's going to take you 10 minutes, 15 minutes, is the first thing we're going to do is you want to figure out what the state of play is, right? So you want to read the financial news, Middle East, oil, ECB, European Central Bank, Fed, China trade, Brexit, macro stuff, Trump tweets, whatever. But like stuff that you're not going to be able to miss when you turn on the financial news, right? The stuff that's this headline stuff, right? You're not looking for something buried on page 50 of the Financial Times. So places like Bloomberg, CNBC, Seeking Alpha, Zero Hedge, all great places. Just have a look at what's going on, right? That's it. Have a look at what's going on. And then what you want to have a look at, you want to pull up a screen that's got some little charts. And I would say you probably want to pull up like either daily or 4-hour charts, something like look at gold, crude, indices, interest rates, currencies, right? Every day, right? So first of all, have a look which events appear to be moving the markets. Now there's two types of financial news, right? The two types of financial news are oil moved today because of X, right? Ignore that, right? There's just nothing more annoying than watching the people in the financial press giving you a cause of something that's already happened as if it makes them an expert in something. So ignore, just try and zone that out because it's a complete waste of time. What you want to do is like, what does appear to be moving in the markets today? And which markets do you expect to be impacted when you're trading? And which markets have already reacted? Like, so if you're trading the London session, look at Asia. If you're trading the US, look at Asia and Europe. And I don't mean you haven't got to go somewhere to look at Asia and European markets. You can actually look at the US markets and see how much they moved during the overnight session, right? So what you want to do every day, because if somebody gives you a cheat list of this kind of thing causes this reaction, this kind of thing causes this reaction, you try and learn it, it won't stick in. What will make you learn this, right? Will make you learn this is that every day you're going to write down what you expect the volatility to be like that day. That's it. And you're going to look at it at the end of each day. And it's only by being wrong and just continually doing this that you'll learn. It's the best way to learn, right? If you can't face being wrong, then I guess, you shouldn't be trading, right? But the idea is every day you have a look, what moved, what do I think is going to be impacted, and what do I think the day is going to be like? Now, sometimes you'll get big news and the day is just completely flat. It just happens sometimes. But a lot of the times you get this big news, it plays out in the market. A lot of times you get this big move and it only affects crude. A lot of times you get this big move, it only affects interest rates. So just getting a feel for that. It doesn't mean you have to trade interest rates, crude, gold, indices. It doesn't mean you have to trade them all, but it means you should be aware of what's the catalyst for moves, right? So that's your first exercise in situational awareness, and just do it every day. Now, if you don't get anything from this in a month, you can come and throw tomatoes at my house. Everybody I've gone through this with has really enjoyed it, and I don't bring anything here that I haven't been through with people privately and that I've seen work, right? So situational awareness number 2. Then we get to the calendar, right? So if you don't know Journalytics, you should be using Journalytics. We've got an economic calendar. It's got pre and post market warnings, so you know when something's about to come out. But basically, with each scheduled economic event, right, all you want to look at, you obviously want to look at the calendar before. I mean, on Journalytics, it will tell you 1 minute and 5 minutes before an economic event. It'll tell you it's coming. Just keep an eye on it and make sure on one of your screens you've still got up crude, gold, interest rates, indices, euro, currency. So have a look. Was it a hit or miss or in line? Okay. which markets moved off the back of it, right? And I got, was it a hit or a miss? I think we covered that one. So just basically start to get an understanding of how things miss. It used to be the employment numbers were massive, right? Like they used to be really, really big. And so they're a big one to watch, like PMI, that kind of thing. Ignore the kind of the green, orange, red that you see in these economic calendars. Just watch the US ones. There are some other ones that you can watch as well. The European ones are actually quite good. You can watch other markets in Asia. Look at Japan as well. But look, was it a hit or miss? What was the reaction? Okay, and did it affect the market you were trading? So just get an understanding of which events move the market and how. And it might be that in a month there's not a lot goes on, but it might be in a month we get a big miss on the employment numbers and the S&P moves all day and you're trading the S&P, or crude moves all day and you're trading crude. Or you might get crude inventories in on a Wednesday or a Thursday if the Monday's a holiday, right? And you get a big miss or a big hit on the crude inventories and crude moves all day. And if you and just to know that event gave me a move that lasted for hours, that's enough. You don't have to trade the news event to benefit from it. Now, there are two kinds of economic event, right? One kind of economic event is the ones that are scheduled, the ones that are in the calendar, right? That is one type of economic event. There is a second type, and it was really funny because I was at Axia in August, and I went there, and it was a particularly terrible day. I went there. There's quite a few people had gone against one of the news events, and there were quite a few people sitting on a losing day. And apparently every time Axia has a barbecue, they have a bad day for the traders. But anyway, so I go around the trading floor, and he's like, "Hi, how is everybody?" And it's like, "Ugh." Okay, fair enough. And so basically, we had the barbecue, and everybody went down, had a few beers, and everybody was fine. I had a beer, and it was fine. And then there was a news announcement, which is of the second kind, right? So sometimes, if you notice, I think it was last week or the week before, just after the Saudi oil attack, there was an announcement that 1 p.m., one of the Saudi ministers was going to come to a press conference and tell us exactly how quickly they were going to recover from the bombs and how quickly they're going to get production back. Now, what was going on that particular day was a news announcement where Donald Trump was going to come on a news announcement, and the news was basically that the EU had lifted, or the EU was going to talk about some sanctions they had on US beef imports. So they were blocking US beef imports. So basically, this news was coming out, and Alex said, "Come on, Pete, come and see this. You'll really enjoy it." It's like 20 minutes before this news came out, Alex drags me away upstairs. My wife and kids are downstairs talking to all these traders, which basically means traders on one side of the barbecue area and my family on the other. Alex drags me upstairs, like, "You got to see this, is amazing." So basically all these traders are sat down and waiting for this announcement on US beef exports. And what they've got at Axia, they've got the audio squawk. So they had that turned up. And then the closer you get to the news, the kind of quieter it gets. And they'll start talking about, well, this is what I think will happen, and this is the way I'm going to trade it, and this is the way I'm going to trade it. And they've actually got a video feed, which is a news feed, but it's about 15 seconds ahead of CNBC. It's not like a cheat or anything like that. It's just by the time CNBC put something out through the regular squawk, so the financial news like CNBC, they've got a cameraman there, but it has to go through their network, and that's a bit slower. So they've got basically one channel where they can actually see these events ahead of anyone else. So they're all sitting there, right, and they're all talking about this guy's doing this, and then you get about 5 minutes before, and everyone's going shh, 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 like that. And then Trump comes on, and the announcement's great. They've lifted a lot of bans on European beef. There's going to be so many dollars, billions of dollars of US beef going out. And the market was absolutely flat. And it was I waited 2-3 minutes after the news, and it's like, "Alex, I think I better go, because this isn't going to really improve anyone's mood." But the reason I'm telling you that is because a lot of people do that. Now, the thing is, before that announcement, that's what they thought was going to be one of the big payoffs of the day. Before that announcement, they were all downstairs. There were a couple of guys. They've got an outdoor gym. They've got a barbecue area and an outdoor gym. And I was like drinking a Heineken, watching these two guys like pumping iron and lifting, flapping these ropes or whatever you do nowadays, really getting some exercise before they sit down to this announcement, right? So of course, if there's so many people sitting down for those announcements and maybe doing what I actually do, like having a walk, getting some lunch, grabbing a beer from the fridge, doing some exercise, right? It also explains why there's that lull before. Right, but those events, like if you see an event like Draghi and Boris Johnson are going to do a press, going to have a press conference about Brexit agreement at 2 p.m. There's not a lot going to happen. A lot of people are going to say, well, let's get ready for 2 p.m. and let's kind of mentally prepare and sit down for that. So when you're looking at economic events, do not miss those. Do not miss the fact there's a meeting or a speech or an announcement or something like that, and because they're real big payoffs, right? Now, the funny thing was, the one I talked about earlier, the Saudi, I'm still annoyed about this. There was an announcement, I think it was last week or a week before. It all blurs with me. I don't know what week I'm in. But basically, when they said the Saudi minister is going to come on at 1 p.m. and he's going to announce, tell how we're going to recover production after the drone strikes, I'm sitting there thinking, 1 p.m. crude, that's probably going to be quite interesting. And then 9:40, it just comes out over the wires. It's like just gets released over the wires. And I was kind of shocked because it seems a little bit naughty to me that like you've already told everyone it's going to come out at 1 o'clock and then they just bang, 9:40 came out. And when I see things like that happen, I think there's a bit of naughtiness going on and really that somebody knew that was coming out then. And then they took the market by surprise. So keep your eye on those. And of course, you might get hoodwinked. Unscheduled news. And again, this is something I might plug Journalytics a bit, but unscheduled news is also something you should listen to for exactly the same reasons. And the reasons you should listen to unscheduled news is basically something might come out that initiates a move, and that move is sustained, right? A Trump tweet, a bomb, which isn't really good. I don't like using the example of a bomb, but it does move the markets, right? And something will happen, and quite often what will happen is you'll actually see the move in the market before you get the news, right? Sometimes you'll see the move in the market. It's like, where did that come from? And then you'll go over to your squawk and you'll say, that was probably it. That was probably it. So a lot of times you don't react to it, and sometimes you miss the news. It kind of washes over you, something like that. So don't worry about being on it. What I do is personally, I actually wear headphones when I trade, but I have a laptop behind me that plays the news squawk, right? So I kind of listen to. I like to have it out loud because it annoys my wife because I trade from home. But I like to have it out loud so that I've got it in the background and it's always there. There are no specific times when news comes out. Obviously, if it's unscheduled news, it's just going to come out whenever, basically. Right. So what we do at Jigsaw, obviously you probably know this. For the real-time news, we've got the audio feed here, which is kind of like a filtered. You can put filters in there. That's the filters I use that I give to people. If you just click hit this, you can have the audio. Then the economic releases. If I just go back to a previous day on this, you get economic releases. It'll actually give you all the ones for the day. This is my time zone. If you're looking at today, what it will give you here, it'll just give you the remaining ones for the day and 30 minutes ago, because you're not really interested in what's happened an hour ago. So you'll get, if I just show all, you can see all for the day, and you can see them all. But this will give you a 1 minute and a 5 minute warning, and it will also give you like a browser notification as well when the news comes out, right? So basically all you're trying to do is understand how the markets are currently reacting to news of different types of topics. I mean, the stupid thing is, really, I think it's ridiculous, right? How long have this Brexit thing been going on? Squawk, Jason's asking which squawk I use. This is a squawk I use. It's part of Journalytics. So this is actually a real-time news feed we've got built into it, and you can do things like go off to the news as well. So I just have that on. and just use that. So that's our own feed, and that's kind of something that I work with. Okay, so 2006 June, UK voted to leave the European Union. Big dive in the market. Ever since then, virtually nothing's changed. Nobody knows if we're in or out, right? But every time there's some Brexit move, the market reacts as if that's the final answer, right? I mean, do you not think it's stupid, right? Every time we get some news on Brexit, the market appears to react as if that is final or real or going to happen, right? It is ridiculous, right? But what's happening, it's not really the market reacting to it. It's just a lot of traders trying to piggyback the news. I think a lot of the time it's just the traders speculating, right? Absolutely. Deet is asking, how soon will results arrive after an economic release? After an economic release, fastest ones are about 2 seconds. It just depends on the back end and how those releases come back through. If you want a trial of it, Deet, you can have a trial and compare it to things like Forex Factory, and you'll see obviously a lot faster than that. But like, it's just a matter of, right, the reaction is stupid, right? The reaction to Brexit news is stupid because it's never been finalised, and to still after 3 years be treating every piece of news as if it's the outcome is ludicrous, right? So, but you're just trying to understand how markets are currently reacting to news of different types and topics. Like the China trade war, right? It's two guys, one in America and one in China, beating their chests, right? That's all that's going on. It's not, none of it, it's real in terms of we've got some short-term impact, but like, the reality is they'll sort it out. Anyway, the other thing about situational awareness is it's not all about news, right? It's not just keep an eye on the news and suddenly you'll be a genius, but already we should have, just doing those things, we should have an idea, okay, based on what's gone on before today, this is the volatility expect. These are the things that are going to happen today that might affect volatility. I've just heard some news, it's taken off. That kind of thing is going to give you the confidence to go on your trades. So I should be trading or I shouldn't be trading. Other things, time of day, right? Right, 9:35 a.m. Eastern time is going to be more volatile than 11:30 a.m., right? That's just a given, right? If you're in the middle of the day's range, or the middle of a 4-day range, or a 5-day range, or a 10-day range, it's probably going to be slower than if you're making new highs on the day, right? Just a given, right? So don't ignore that. Don't just say, well, my candlesticks turn green, I'm going to trade, right? Correlations, if you've got market with good correlations, follow through is better on the ES. His follow through is better on the ES when the NASDAQ and the Dow are in sync, right? The other thing is overall liveliness on the markets, right? If there's good participation in the markets overall, you're likely to see it across gold, the dollar, the euro, the bond, US interest rate, crude indices. You're likely to see it across all, right? If you see just one market bubbly, if you're looking at crude and crude's active but nothing else is, and the S&P's slow, then you're probably not going to get follow through in the S&P, right? Is it just before an announcement? Is it the FOMC morning? All of those things are just giving you the situational awareness so that we know what's the scope on our trades. What's the scope likely to be? If I take a breakout now, what's it likely to give me? You can ignore all this stuff, but this is what affects how much you get out of your trades. So you basically need to understand how the traders are playing this market, and often they just might be sitting on their hands, right? And if other traders are just sitting on their hands, then you might want to sit on your hands yourself. So, we've got the pre-market stuff, we've got intraday stuff, and location, where we are, right? Somebody said to me the other week, they said, I was in a trade, Pete, and it kept going. So I was in a trade, and the market was going sideways for 30 minutes, and it ticked up. So I wasn't really sure which way it was going to go, if it was going to go my way or not. And I went, well, nobody did. Because if they did, it wouldn't go sideways for 30 minutes, right? So it's like don't try and predict everything. It's like if the market's flat, it's flat for a reason. Don't try and, there's no point sitting in stuff if it's flat and it's just going backwards and forwards. For a long time, what that means is the market's not sure. So it's okay to be not sure yourself. Now, the other part of this is once you do this and you get situational awareness, you're suddenly going to realize that there is more opportunity on some days than others, and it will help you to stop, doing like the stupid stuff, right? So I often get traders, they'll ask me questions, and this happened a couple of weeks ago, right? Somebody said, there were these 2 days. There were 2 particular days they pointed out, and it's something like, on some days the moon is low in the summer sky. Trump hasn't put out a tweet. We're in the middle of a 3-day range. I'd had Weetabix for breakfast, and there was no move in the UX markets overnight. The market's open with a push up, but then fade away and chop about. How do I play that day? And so, whoa, that's really specific. How do I, in other words, they pick a recent day they lost money, define it in very specific terms, and they want a laundry list of how to avoid losing money on that day. And the answer to that is, you're just going to have to lose money on those days. That's it. You lose money. That's your answer. That's the answer. You cannot put a system in place where you make money every day. Not unless you're like a hardcore one-tick scalper, which none of you are. But if you're trading directional positions and you're trying to get runs, there is no chance that every day will be profitable. So I'll tell you this, absolutely. There's a guy at Axia a few weeks ago, made £500,000 in one day. That guy has losing days. They're never that big, right? They're never that big, but that guy has losing days, right? So, the big guys have losing days. It just comes with this style of trading, right? So it's normal for like your retail trader that when they're on a good run, they're on a good day, they feel like king. I was talking about this to somebody just an hour ago or 2 hours ago. They feel like king when they're on these days when the market's going their way. It's like, I've got my finger on the pulse, man. I can literally do no wrong today. You could turn around, click one of the buy or sell buttons, turn back and you've made money, right? The next day, you feel like an absolute idiot because you can do nothing right. Anybody ever felt like that? There you go. Well, here's the news. You can now stop patting yourself on the back for those days you felt like a king, right? And you can stop kicking yourself for the bad ones too. Because you know what? Not everything is about you, right? Not everything is about you. Not everything that goes wrong is a problem with you or something that you can fix. So on the days you feel you can do no wrong, the market is simply in a state that suits your approach, right? When you can't do anything right, the market is in a state that doesn't suit your approach. And you know what? You can't always tell in advance. You can't always tell. Sometimes it looks okay. You might have a bit of trouble getting in. It looks okay, but God, it just keeps watching back over you every time you get in a trade. So you stop, right? So like I say, it's not always easy to tell in advance. And while you should always strive to get better, that it's only so far you can go on a day. So if you have a day where you can't make money, right, and you keep trying to make the losses for that day back, you're going to dig yourself into a hole, right? So the guys making $500,000 a day or £500,000 a day, they still have losing days and they stop because it's just not happening, right? And if they can do it, so can you. So, what a lot of people do is they just battle. They turn that day into a battle of tooth and nail trying to claw it back. So just don't understand that, like, the day they felt like king just as the day when the market was good, right? So we're all day traders here, right? We're all day traders here. But as day traders, the most opportunity exists when there's real money coming into the market, right? So if you ever heard of somebody talking about the pits in Chicago, they talk about, there's paper coming in from Goldman. Have you ever heard that? There's paper coming in from Goldman. And they'll go crazy because Goldman's got a bunch of orders to fill. Right, so what was happening there is like Goldman, they'd see somebody walking down with a bunch of stack of papers. And Goldman were basically going to come with a lot of orders to the pit. And they're bringing those orders to the pit. And they were prepared to give up some ticks in the spread to get filled at a price that they could guarantee, right? So they come down with paper. Everyone gets excited. Goldman's bringing paper into the market. Boom, 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 boom. So all these guys in the pit are buying, trading with Goldman, laying it off on another market, and they're making a spread, right? Okay. The pits were lively. There was money to be made. So this idea that paper's coming into the market, there's real trade in the market, right? That's actually what you need to make money. If you don't have that, right? If you don't have that real interest in the market, real institutions, people trading the time frame above us, forget the people time frame below you, HFTs, that's not where it's at, but the people trading time frames above you, if they're coming into the market, they are bringing opportunity, right? Now, if there's no interest coming into the market, right? If it's just speculating in the market, who are we trading against? Who do you think we're trading against? Us. each other, right? So do you want to be in a market? Yeah. Do you want to be in a market where there's a bunch of people trying to do the same thing and make money off each other? Or do you want to be in a market that's got direction and momentum, where there's opportunity, where we can actually piggyback it? Right, the latter. Right, the latter. Okay, so we actually need something. So, and it's one of the reasons Axia do what they do. It's one of the reasons the briefing.com people do what they do. It's one of the reasons, yeah, it's other time frame participants, right? Now, one of the reasons there's all this talk about HFT and algos. HFT are basically, they're taking, they're market making. They're taking a penny, taking a penny, taking a penny. You can have the best software in the world that tells you what an HFT is doing, but by the time that software has told you what an HFT is doing, that HFT has already done it again 250 times in 125 different directions. Right? Absolutely pointless. What you need is the guys above you. You need that interest in the market, right? So you want something to piggyback in the market, right? And I heard a quote, man. It's a great quote, and I'm gonna use this forever. But there was, it makes me laugh now. There was one market. I'm not going to say where it was. We'll probably talk about it another time. But there was a lot of spreading activity, and there were a lot of prop firms spreading in one particular marketplace. And then the real trading in that market dried up, right? The real trading dried up. But the guys doing the spreading, the spreading, they kept on doing what they were doing. And what was left in that region was a number of prop firms trying to trade the same techniques, effectively trying to make money off each other. And I talked about this a couple of weeks ago to a friend who's a trader, and he just came out with this. Nobody told the seagulls there was only one French fry left in the parking lot. I think it's absolutely fantastic analogy for trading. But like we do need somebody to be trading, right? So if it really is just that one French fry in the parking lot, and you try a few times to make money and it's not happening, just get out of the parking lot. Come back when somebody drops a bag of chips, right? So whatever you trade, if it's dead, you might just be one of many seagulls trying to battle over that one French fry, right? And if that's what appears to be happening on any specific day, there's absolutely nothing you can do that's going to force opportunity back into the market, right? Absolutely nothing. Right, I'm going to go, and at that, we have question time. I'm going to go over some questions that we've got in there. There's only a few questions, so if you want to add some more, you can add them in the chat, all the questions. How do you do daily debriefs if you trade by yourself? I think there's a few ways to do it. I mean, I know Axia have got a service. I've never used it because I like to do my own thing. Axia have got a service where you can look at their debriefs, but I think it's just get a coffee. I like to get a coffee and read the news. And I just think it's a matter of reading it, just getting into the habit of reading it, looking after the day and say, how did that affect it? But I'm sure there are services out there that are helping it. There's Eurex have got a good newsletter. So I actually get an email every day from Eurex that kind of gives their input, and I think that's a good one to have. How does one best track order flow? Well, this is Jigsaw. Order flow isn't the same as volume, but volume is part of order flow. So I think I consider volume and tracking volume to be a part of the discipline of tracking order flow. Obviously, I like to use Jigsaw tools because that's what we created. So our tools are basically there to track order flow. But basically, it's the DOM. The price ladder is the best place. That's what all the prop firms are using. They don't really get into heat maps at the prop firms. We talked about how soon the results arrive after an economic release in Journalytics, and it's obviously a few seconds. Journalytics browser notifications don't pop up. There are settings in Chrome, but you just need to, Ryan, something like that, just Google me or just Skype me on Jigsaw Trading. It's all one word, Jigsaw Trading. If you can't see the notifications, I'd like to have a look, because if there is something that I haven't covered in the manual, then I'd like to see it. Does anyone at Axia trade very short-term scalps for a few ticks? Generally, they're trying to get into runs. Now, they are trading. They're obviously trading when there isn't news as well. If it's a slow day, they don't just not go to work. But most of them are trading for a bit more. If you want the best trader for just very short-term scalps, John Grady is a good guy to talk to, because he does a lot of that, short-term scalps. So he doesn't really like to trade the news. But also John will try and take runners when they're available, but he's very happy to scalp. And then the other one is Gary Norden, if you can get hold of him. Triphone, how do you judge when higher time frame money is coming in? It's just something you just get experience over time. When you see, when you constantly see news, if you see a tweet from Trump, I don't know, 7 times out of 10, it moves the market, right? So it's that kind of thing. You get them often, the moves, you don't have to get the start of the move. So quite often the move will happen. Then you go and look at the squawk. You'll see that Trump said something and you can say, okay, well, that probably is going to be sustained. Can you get 2-day rolling VWAP in the DOM? Well, we are going to do that charting package whenever the slaves finish that one. So that'll be in there. What other elements of daily prep? Well, just the ones we talked about there, which is, we go over those again. Slide from current slide. So it was, if I have to go back the old fashioned way, right? So it was the financial news before the economic events plus the unscheduled press releases and press, what do they call, press briefings, keeping your ear on the squawk, and then being aware of all the different things just generally intraday that affects the market. Other elements of daily prep, you can look at like key levels if you want. I tend to do that less now because I tend to just don't be at a point where I need them. This is being recorded, Bob. We'll send you something. You can get initial balance area too. We're actually going to have market profile as well there. If you didn't manage to arrive on time, or which is a great name by the way, there will be a recording. Prop firms that could back a trader. There's a whole bunch of them, Andy. If you go offline and tell me what you do, if you send me an email, then I can better advise you. But generally speaking, prop firms will want you in house. It's not like when Top Step and stuff like that, they're the exception. So even a prop firm that would let you trade from home will want you in house for a while. So I know actually I've got some people that trade from home, but that's just like there's no way they're going to back you right at the start from home. They want you there. They want you monitored. They want you part of their team. They want you, using part of their daily meetings and stuff like that. So you would want to go to a prop firm on location, and I wouldn't take, I wouldn't say I wouldn't take them seriously, but I would wonder about a prop firm that let you send them a trading statement, and then they said just set you up and let you do it from home. I'd wonder what their where their common sense was. We can get access to previous monthly therapies. Previous monthly therapies have been kind of cursed. There are some online, but we've kind of been cursed with recordings. I've actually got 2 recordings running now because I think the first 6 we just couldn't get a recording to take. Untrade's the same. It's like Top Step. You have to pass a combine and then you get funded, but that's different from a prop firm, right? It's a prop firm. The difference between like these a prop firm is like you might have like a $10,000 you might have a $10,000 max loss on a day in a prop firm, but you might lose 20,000, and they'll look at the day and they'll say, "Good grief, everybody lost today. The market spiked down on some bad news. Just carry on." And I don't think you get that with these kind of more automated, less personal prop firms. You're not going to get the same thing. Also, I don't know what how big you can scale up there on them as well, and how big you can go offside. So I think if you're at that level and you want to be trading 500 lots, I think you're going to have to go bricks and mortar. If you are in a position you want to trade other people's money, I think those services are great, right? I think those services are great. But also, if you're looking to be trading 500 lots, something like that, I think bricks and mortar, you might find the backer of the firm who's going to want to meet you. Right, so I know the Axia, they've got a person that backs them, and Axia, some of their traders back other traders as well. Right, so you might have a trader that actually puts the money in for another trader. ETF charting package. Well, it's going to be this year. It's just a matter of I'm testing it every day, man. I've been quiet on the chat and stuff like that because I'm just trying to hammer this thing every day. There is a Jigsaw discount if you start on Top Step. For some reason, the link's broken at the moment, which I'm waiting for an email back from Connor. But I think in terms of the situational awareness, is that all clear? Is it clear the benefit? Okay, so what you'll do is if you start doing this stuff, you'll actually feel the benefit, and you'll actually feel that on the slow days you kind of understand why it's slow, and hopefully you'll understand if you keep the French fry analogy in your mind, that you know, it's just you and a bunch of other guys trying to make money. That's why it's moving the way it is. And so good luck, people. I thank you for all the questions. Thank you for participating. I really do enjoy these sessions myself. So I will end here, and I will package up a recording and send that out to you. And good luck with your trading, and see you in a month.